Welcome to This Explainer, where we're going to treat structured products like a giant financial laboratory. Today, we're taking a really deep dive into how quantitative traders actually synthesize equity, fixed income, and credit risk into highly specific, tradable assets. We'll be drawing our insights directly from chapters 11 and 12 of a great source, 151 Trading Strategies.
All right, let's quickly map out where we're headed today. 1. Slicing risk and CDO mechanics. 2. Mark-to-market and risky duration. 3. Trenchy carry and delta hedging. 4. CDO curve trades and MBS. 5. Convertibles, focusing on fixed income and equity. And 6. Convertible option-adjusted spreads. Let's get right into it.
Starting off with Section 1, Slicing Risk and CDO Mechanics. So when you buy into a collateralized debt obligation, or CDO, you usually don't buy the whole pool, right? You buy a mathematically defined slice, or tranche. Your attachment point, little a, defines exactly where you start taking losses relative to the total pool size. Then you have your detachment point, little d, which is the exact threshold where your capital is completely wiped out. It's essentially a precision tool for isolating exactly how much risk you actually want to absorb. Now, to measure that exposure, we calculate the expected loss. Looking at this formula, it might seem a bit dense at first glance, but it's actually incredibly elegant. What it's doing is calculating how the probability of specific defaults multiplied by their real dollar amounts penetrates your specific tranche's boundaries. It mathematically isolates the danger to your exact slice by tracking where losses fall between your attachment and detachment points. You've really got to keep the distinction shown here in mind. Cash CDOs are backed by a physical pool of actual tangible loans or bonds. Synthetic CDOs, on the other hand, are basically derivatives of derivatives. They're built entirely from credit default swaps on underlying indexes. It's the exact same math, but a completely different physical reality backing the trade. Moving right along to Section 2, Mark-to-market and risky duration. Think of your mark-to-market value as a mathematical tug-of-war. On one side, you have your premium leg, that's the P, which is the cash flowing in from periodic spread payments. On the other side, you have your contingent leg, or C, which are the outflows triggered when expected defaults hit your tranche. Simply put, if the premium coming in outweighs the default hits going out, you're in the green. But how sensitive is that setup to wild market swings? Enter risky duration. This is absolutely crucial, because risky duration acts as the mathematical elevator moving between our risk layers. By taking the first derivative of the mark-to-market value with respect to the credit spread, it tells us exactly how much our tranche's value is going to swing if market credit spreads widen or tighten. It's literally the ultimate sensitivity gauge for credit derivatives. All right, let's look at Section 3, Tranche carry and delta hedging. Take a look at the juxtaposition here between two distinct carry strategies. Strategy 1 is pretty aggressive. You buy the lowest quality equity tranche to harvest that high premium, and you delta hedge the broader market by shorting the underlying index using a very precise ratio. Strategy 2 takes the exact opposite approach. You sell a senior tranche, buy the index hedge, and harvest the premium from the hedge itself. But what if you aren't using a broad index to hedge? Well, you can get way more surgical. You can use a tranche-tranche ratio, matching the risky duration of a low-quality tranche against a high-quality one. Or you can use a single-name ratio, hedging directly with credit default swaps to practically neutralize the risk. It all comes down to matching the risky duration of your asset exactly with the risky duration of your hedge. On to Section 4, CDO curve trades and MBS. Now, just like traditional bond yield curves, CDO spread curves can actually be traded directly. If you expect the timeline gap to shrink, you put on a flattener by selling short-term and buying long-term risk. Expecting it to widen, you put on a steepener. Your P&L is simply the mark-to-market of your long position minus your short. You're quite literally trading the timeline of credit risk. Okay, pause for a second. Before we get into mortgage-backed securities, we absolutely have to talk about this central risk metric, negative convexity. Unlike a normal bond, when interest rates drop, the price of an MBS doesn't skyrocket like you'd hope. Why? Because homeowners refinance their mortgages. This prepayment risk caps your upside and creates a uniquely difficult mathematical curve that you have to manage. So how on earth do traders beat that negative convexity? Strategy 5 breaks it down. To extract yield from MBS pass-throughs without getting totally crushed when everyone refinances, traders meticulously duration hedge using interest rate swaps. But here's the catch. This only works if it's guided by incredibly robust prepayment models. We're talking complex structural models or non-parametric regression. to predict exactly how humans are going to behave when those rates change.
This brings us to Section 5, Convertibles, bridging fixed income and equity.
Convertibles are just fascinating because they literally synthesize two different asset classes into one. You get the downside protection of a standard fixed income corporate bond, bundled directly with the explosive upside of an equity call option. It is a single, unified, tradable instrument that spans the capital structure. And here is how quantitative funds actually exploit that synthesis in Strategy 6. You calculate the option delta, and you multiply it by the conversion ratio C to find out exactly how much underlying stock you need to short. By updating this delta hedge daily, usually over a 6 to 12-month period, a trader systematically extracts the arbitrage premium, basically the cheapness of the embedded option, while completely neutralizing the daily swings of the stock market. It's a brilliant play.
And finally, Section 6, Convertible Option Adjusted Spreads.
The logic here is a pure price decomposition. A convertible bond's total price is just the straight bond price plus the value of that embedded option. By mathematically shifting the treasury yield curve around until our model matches the real market price, we isolate exactly what the market is charging for that option alone. That is our option-adjusted spread.
Once you can isolate that spread, boom, Strategy 7 opens up. Convertible Option Adjusted Spread Arbitrage. Imagine a company issues two different convertible bonds. By holding the bond with the high spread and shorting the bond with the low spread from the exact same issuer, you effectively remove all the company's credit and equity risk. You are purely mathematically trading the expectation that those two option spreads will eventually converge. These strategies, they're an absolute masterclass in isolating and extracting specific risk premia from synthetic assets. But as we wrap up this explainer, it definitely leaves us with a lingering question. As quantitative models get better and better at slicing up credit, equity, and duration, what new, completely hidden layers of correlated risk are currently being engineered into tomorrow's complex financial instruments? Thanks for joining me on this deep dive into structured assets. Keep analyzing and keep learning.